yeah, if your portfolio's gotten hit, I mean, this is a great time to be doing some Roth conversions.
And welcome into the program. This is Protect and Grow Chicagoland Retirement with Chicagoland's certified financial planning professional, Tim Stearns, CFP, founder at TJ Stearns, Inc., the local resource for proactive Chicagoland area savers and investors looking to get that Protect and Grow written retirement blueprint. You can get that there at TJ Stearns. And we always appreciate the perspective and insight of Tim Stearns, CFP, because Tim, you're our investment guy. What in the world is going on with the markets and where do they go next?
Well, it's a lot of volatility. The market did not react real well to the tariffs. It remains to be seen what will happen there. But, for us, we're about tactical money management. So in many cases, we got out of the market. And, what makes us get back in, we're looking for different signs that proprietary wise tells us that. And we've done really well over the last, 15 to 20 years. But there's a lot of things that I'm seeing with people that come in to meet with us that they didn't realize how much risk they had.
Yeah.
And we're trying to make sure that from their old advisors or they've been do-it-yourselfers, all good things must come to an end. We've been talking about this on this show for how long, Peter? That the market has a habit of retracting, and it's doing that, and that's nothing new. I think we forget it those years.
Don't realize how much risk you have until the market turns down. Old saying, don't know who's swimming without their swim trunks until the tide goes out, kind of thing, right, Tim? And I know the question of where does it go next wasn't a fair question, but like as investors who are worried about the market, Tim, what do we need to be thinking about or doing next?
Yeah, making sure that you have some defensive measures. I mean, it's never too late to put those in. Our clients, have some money that is safe, like in annuities and that type of thing, or in covered call, investments where, we're making sure we have hedges. We have uncorrelated assets. These are a lot of the things that I'm not seeing people come in with from my classes, from this very radio show. People saying, "Oh, I didn't realize I had it all in 70 to 80% in stocks when I'm 65 years old is probably not where I should be."
Well, things are moving fast. We do need to evaluate, assess, and have a plan, ladies and gentlemen, for the reality that there is going to be market volatility. There always has been prevalent as part of the market is the potential for losses. And now that we have seen that volatility by the end of our conversation, Tim, the values might be different than the start of our conversation because the world moves fast, the market moves twice as fast, and we don't want our money to go away fast. We want to do what we need to do to make sure it's there for us for our future. That's why Tim Stearns, CFP, ladies and gentlemen, offers the value, the opportunity to design for you the personalized Protect and Grow written retirement income blueprint. If you would like to get that put together, pick up the phone, give TJ Stearns Inc. a call, 800-640-2256. That's 800-640-2256, 800-640-2256. Tim, you mentioned we've been talking about this, the potential for market volatility for quite some time. And over the past couple of years, 15 years or so, the market has grown and gone up and up and up. And inherently, doesn't that mean that even those investors who had risk 5, 10, 15 years ago, by nature of the fact that the market grew, now have inherently more risk than they once had? And over time, shouldn't our risk move in the other direction?
But yes, and the easy thing to tell is that stocks have taken the spots of bonds in portfolios unless they're diligent about rebalancing, right? Rebalancing the stocks so that they're back to where they want them to be versus they've eaten up where the bonds were because bonds have not performed. And then you're looking at by the end of it, you're in 80 something percent in stocks, and you're about to retire. And then this happens. And this is literally sequence of returns risk, which we've talked about. So we're trying to, tell people, let's get a plan. Let's stick to that plan. Let's not overreact to different things and make sure that we're, we have some defensive measures in. I can't say that anymore. You want to have breaks on your portfolios.
Again, if you are not sure if you've got those kind of breaks on your portfolio, if you're concerned about the market volatility, if you want to get a plan put in place so that you can see volatility clearly through the lens of a long-term strategy and understand that volatility is going to be a natural phenomenon, but that you can make your way through it with that plan in place. That is what the Protect and Grow Written Retirement Blueprint is all about. You can get that at TJ Stearns Inc. with the help, the assistance of Tim Stearns, CFP, and the team. Give a call, 800-640-2256. That's 800-640-2256. Tim, market volatility is to be expected, right? And yet still it's surprising when it comes, and it hits quickly, and it can be painful. And that's why we need to take steps now to implement proactive strategies. Now, we have already talked a lot on this show by itself that the market has fallen quite a bit. But in the grand scheme of the perspective of the market, when I look at the chart over the last 15, 20 years, like we are nominally lower than all-time highs in the peak of the market. Like could we not have further down to go? Like is it not still a good time to back up, take perspective, and put a protection plan and a growth plan, the Protect and Grow plan, in place?
No, it's never too late. And I always talk about the one example of Maureen, one of my clients who I got as a referral from her sister, and it took her forever to call me. And I kept wondering when the call was going to come, and she finally did. And after we built the Protect and Grow blueprint, which she was very happy with, I asked her, Maureen, what took you so long to call us? And she said, I was scared that you were going to tell me A, I couldn't retire, and B, that I had dumb investments. And, all I'm saying is, we can play doctor and kind of look at things, but we're not going to Monday morning quarterback people. And we are going to show them that there is, this is our expertise, retirement planning. So, let us take over. We'll drive the car for a while. So to get you right. And she's weathering this storm really well. And she hasn't even called us yet. So that being said, I think we've done our job.
Well, that being said, the S&P, the Nasdaq logged their worst performance the end of March, start of April since the
Yep.
beginning of the Ukraine war amid these tariff uncertainties, worst quarter since 2022. Tim, the high flyers over the last 10, 15 years have been dubbed the Magnificent Seven, and there's so much weight and concentration in so few companies. Is this eerily reminiscent? Like, does this not rhyme with tech bubble? Is this not maybe tech bubble 2.0 popping here? It seems like.
Yeah, I hear that. My 31 years in the business, this seems really familiar territory. And thankfully we didn't have a bias into those stocks, of too much in there, just because we're not going to just join the parade because everyone's doing it. We are going to take inventory and make sure that it makes sense for our clients. A lot of those stocks have been beat up really badly, and I can thankfully say that our clients haven't been in that.
But the S&P is weighted heavily. Many mutual funds are weighted heavily in those
Oh
high
yeah.
flyers. Is that why, Tim, like the S&P itself is not a plan? Like an investment in the S&P is not a portfolio. It can be a position in a portfolio and a position within an account within a plan, but just the S&P by itself or investment in the market by itself does not constitute a plan.
No, not at all. And that's not diversification. As you said, those seven stocks take up a big portion of that. So you need to make sure you're in other things that aren't going to just go down when those things go down like a hammer, like they have been. We saw the same thing happening in 2022. And luckily, the market came back in 23 and 24, but now here we are again. So, if you're hold on for your dear lives, there's something wrong, and you shouldn't be doing that if you're, getting ready to retire or are retired.
We are talking with our investment guy here on the program, Tim Stearns, CFP. The home of the Protect and Grow Written Retirement Blueprint is TJ Stearns Inc. If you've got questions, if you've got concerns, if you would like a complimentary, no cost, no obligation review, analysis, a personalized plan customized for you with a long-term vision and diversified strategies. Pick up the phone and give TJ Stearns Inc. a call, 800-640-2256, 800-640-2256. Bottom line, Tim, the market can't go up forever. There are many causes for volatility. When it changes direction without a plan, it can cause fear and anxiety and panic. And then, more often than not, investment decisions that end up being mistakes. That's without a plan. And that's why there is the value of the Protect and Grow written retirement blueprint. So, let's talk about those many factors that can cause market volatility. What are we seeing here? I know tariffs have been the kind of recent headline, but there were underlying issues. The tariffs added some fuel to the fire, I feel.
Well, I mean, we have political unrest, and the market does not like that. Market is very skeptical of the unknown. So what happens is people get nervous and sell out, and then you just see it's a snowball. And that's why, trying to get ahead of it is the first thing. But even if you're in the middle of it, great time to have another set of eyes look at your portfolio and see what's going on inside of it, and basically do an X-ray of it. And that's what we've been doing with many of the listeners here, and then our classes, as well as referrals from people that have weathered the storm with us, and they're not nervous, and they are actually sleeping at night.
Had these same kind of agenda items been announced under a less controversial figure, do you think it would have had the same impact on the markets?
I don't want to get political, but yes, I would agree. I think there's a big bullseye on President Trump, and people are overreacting in many cases, whether it's the burning of
On both sides, right? Fear and dread or euphoria. There's like these
absolutely.
just wild extremes of the pendulum, but maybe some middle ground has a
Right.
case.
Right. I mean, I'm hoping cooler heads will prevail through this, but I'm not, I'm not thinking that will happen for right now. It's going to need to cool down, and that's what I'm hoping. The time will see what these tariffs do, but for that time being, we need to be defensive. I would not go on the offensive right now.
Well, just a point of fact, since 1980, market corrections have averaged 14%, and yet the market has delivered positive annual returns 3 out of 4 years. There are many years where the market goes down by more than 10% within the year, and then the year ends up in positive territory. So this is not a give up, the sky is falling, the
No,
end is near
no.
kind of scenario. And that's why, Tim, again, emphasizing that it is the perfect time to back up, evaluate with some perspective, and put together that Protect and Grow written retirement blueprint.
I agree, and we're getting more people than I've ever had coming in who are very scared. And with that being said, we're reevaluating and helping them get their ship righted, if you will, because I don't think a lot of them realize what they had. Our software Riskalyze really helped with that, to let them, show them that, hey, you lost 10%, but you could have been a lot worse.
Mm.
So let's make sure that we don't, have the same mantra, and strategy that you've had forever.
Is the market itself becoming more knee jerk, Tim? And I ask that because I'm not sure if I can recall any time where there's been such an immediate reaction to any announcement by any politician or financial figure, even like when Jerome Powell speaks and they change the interest rates and things like that, that you can correlate with a direct market implication. It doesn't seem like it plays out as quickly or as significantly. And so I guess I rephrase and repeat the question: is the market itself becoming more emotionally reactive?
Well, I think information is key, right? And now we're all getting it instantaneously. And, the typical investor is overreacted. They're very emotional, and they don't stick to their guns very long. So when they see hell and high water, they're ready to go as far as to get out of the market. And I'm seeing that quite a bit. And again, to my point originally, is that I don't think they realized how much risk they had in it, in their portfolio. And greed is good type of thing. They were getting buying up more of it and buying up more of it, and then now the rug's been pulled out from underneath them, and it just snowballs. And you see this markets go down extraordinarily in 24 hours. Before the futures, you look at them. I haven't seen that since, to your point earlier, the dot bombs era. Where you'd see stuff. I mean, the brakes going in and all that good stuff. That's why you need to be proactive in this stuff and not reactive.
And when we heard about those breakers, it's important to note that like this is not a fuse box on the wall that the stock
Right.
exchange anywhere in
Right.
Asia, right? There are specific safeguards that have been put in place to prevent a complete meltdown collapse, and perspective on these kind of collapses or downturns is also important, Tim. Like back when the Dow was at 3,000 or 5,000, a single point drop day of 1,000 points or 1,500 points would have amounted to something much more much more sizable,
Yes.
much more serious than what it does now with the Dow where it is. It is much higher. And even though the point value was like one of the largest in history, in context and comparison, it was not nearly close to like the most significant drop. Although I've heard it phrased that way on the news. Is this like spin?
Yeah, yeah, I hear that. I mean, to your point, it's not as bad as it seems. And the news people love a bad story, especially when it comes to with President Trump. So it's just feeding off of itself right now, and they're vultures in my opinion. So I just would tell people, you know, cool your jets for a minute, give us a call, and we'll take a look at everything and try to get you set.
It is all about perspective, right? I mean,
Exactly.
I heard it put in terms of like your age and how time passes is that
Sure.
at 10, a year seems like it takes forever because it's
Right.
1/10 of the total amount of time that you've ever known. But by the
Right.
time you're 40, 45, a year flashes by pretty quick because relative to what you've seen, it's a very small amount. And kind of same with the magnitude of these market shakeups is that they happen from time to time, and the numbers are larger because the economy has expanded, the market has expanded, it is larger,
Right.
and we are, Tim, more global with our
Yep.
investments, right? Is it when you talk about tariffs, that plays into this global economy and has ripple effects.
Right. And I saw the other day where the market, the rumor was that he was going to suspend tariffs for 90 days, and the market reacted positively. And then within a half an hour, that rumor was dispelled, and then next thing you know, it went back down.
Right.
So yeah, I've never seen anything lightning quick like it is now with information sharing. We everyone has a smartphone, even my 95-year-old mother, they're getting information lightning
Texting
quick.
away.
Yeah, and exactly. So you have to be careful, what you have in your portfolio, because you and I have always said this. The bear market takes the elevator, the bull market takes the stairs.
Yeah.
So when you're losing value, it sure does hurt. And if I'm getting ready for my retirement and I'm looking at sequence of returns risk, something needs to be said.
Does mom use emojis yet, Tim?
She does.
See?
Yes.
Yep.
Yeah, she's a cool 95-year-old.
All right. Well, we've talked enough about the market volatility as a fact, but now, Tim, let's talk about the strategies and the questions. Like, what are investors doing? What are the questions they should be asking themselves? Number one, right? Self-reflection. Am I taking too much risk?
Right. And how do you know that? Well, if your portfolio got hit in the last couple of weeks, you probably are. Our clients have a protect and grow plan so that, what is retirement all about? It's about paying your bills. So our clients are set up with guaranteed income that will augment what they're getting from Social Security, or if they're lucky enough to still have a pension, from their pension. And then, the stocks being down right now isn't the end of the world, and as I said, in many cases, we went to cash. But we're looking at the ability to be able to pay your bills while the market's down and wait it out. And that's what we are doing with our clients.
I know many would say retirement's about not working anymore, Tim, but while not working, also being able to continue paying your bills is
Right.
important. That's why you
Right.
need that protect and grow written retirement blueprint. All right. So maybe question number two, somebody should be asking themselves is if I retired right before a market downturn or in the midst of a market downturn, would that affect my income? And I know that's a big part of that protect and grow blueprint, Tim.
Right. It's about guaranteed income. And you're looking at the fact that interest rates are the highest they've been in my 31 years in the industry. So if you're looking for some guaranteed income, right now is the best time I've ever seen. Even as far as 2 years ago, rates were lower. And now with them being so high, if you're a saver and you want guaranteed income, it's by far the best guaranteed payouts I've seen.
When do
Um,
you begin making that shift? Like, should we're kind of talking about questions investors might
sure.
be asking themselves. Do you
Yep.
find people asking like, have I captured enough gains to begin shifting to an income focused portfolio?
Well, or do you think the market's too high? In some cases that it could go down a lot. That's what made my wife and I do it, and we don't have a pension. So I moved some money off of my IRA into an annuity, and I'm glad as heck I did it because, now I have some guaranteed income at interest rates being some of the all-time high I've ever seen. So that's what it's all about.
I know retirement, Tim, is not just 2 years, 4 years, hopefully,
Right.
right? We've got to
Right.
plan out well beyond even what is the foreseeable future. So we have to continue to worry about elections and political
Yeah.
changes in climate and environment for years and decades to come. Politics is probably going to continue impacting the market, correct?
I don't think they'll ever go away. I don't know if the days of everyone getting behind one president are going to come back. So we've had some pretty,
I don't know if they've ever been here,
yeah.
in total
Well,
fairness.
like from what I hear from baby boomers, Kennedy kind of rallied the troops for a lot of people. But getting back to what we're talking about is, it seems like people disagree just for the sake of it. And I guess that's too bad, but I mean that makes for an uncertainty that the market doesn't like. So I would make sure that I have covered calls. I'm hedging. I'm doing uncorrelated assets. I'm not all in the stock market or all in bonds. When people come in to see us, they have three flavors: cash, bonds, and stocks, or they'll have a mutual fund made up of that. And that's not the way to do it. There's so many other assets that you should be having in your portfolio to reduce your risk.
Tim, is there reason and value in considering annuities or other guaranteed income products at a time like this?
If you like to be able to know for a fact that you'll be able to pay your bills, yes. I believe in them. 15% of society has a pension nowadays. We're looking at, people believe in Social Security. Well, how about having a guaranteed income from your portfolio? That it goes up with inflation. I mean, these are things that we're accomplishing with our clients better than we've ever been able to.
Tim, looking for the silver lining of the gray cloud of market volatility. Are there any strategic moves that we could be considering right now to take advantage of in a
If your
volatile
port,
market?
yeah, if your portfolio's gotten hit, I mean, this is a great time to be doing some Roth conversions, right? If you really believe in XYZ stock, or whatever the stock might be, or whatever your portfolio looks like, lock in the loss where you can move it over to a Roth conversion and let it grow back up as tax-free, uh, you know, uh, a tax-free vehicle, and then tax deferred, obviously, the whole time. What a great opportunity if you're going to try to make lemons with lemonade.
Not an endorsement of XYZ Corporation, by the way.
Yeah, no,
Right?
not at all.
No,
No,
just
no
a generic
corporation.
letter saying whatever
Yes.
stock you might have that you're a fan
Yeah.
of, if you
If it's
believe that
gotten beat
company
up,
is a
right
good
now might
company.
be a great time.
Yeah, yeah. Roth conversions, I know, has been a big topic of discussion and strategy of consideration there at your firm at TJ Stearns Inc. with your clients, Tim. I- Is everybody hearing about Roth conversions and the opportunity that they can present the way that your clients are and listeners to the show have been for years?
Many of your listeners are coming in here and telling us that their current money managers, because I'm not going to call them advisors because they won't tell them, advise them on things like this, won't help them with the Roth conversion. And that's why having a CPA here really comes into a handy conversation that we can say how much is the tax bill going to be to do this Roth conversion? Does it make sense for that person? We are full service here. We kind of cover A to Z. That makes it a lot better for the client who doesn't know the answers to half of that stuff.
I hear a lot about contributing, adding more when the market's down, buy
Sure.
while things are on sale, rebalancing, and tax loss harvesting. Are all of these strategic opportunities that you help your clients identify?
Of course, we are always looking for opportunity, but we're also looking for blind spots and trap doors. And we've told everyone for a long time that there's a trap door with this stock market, and we've seen it come to fruition. So now it's just a matter of getting their heads straight and getting them back involved, so that their stocks aren't going to all take a hit.
Tim, we don't ever want to be left behind and miss out on the opportunity of the growth of the market. But there is an absolutely valid, essential reason and purpose for safety in our portfolio. And I think that striking the balance is the critical aspect of having some protection, having some opportunity. And I think that's why I aptly name the plan and the process that you put together there. The blueprint is the Protect and Grow written retirement blueprint for your clients there at TJ Stearns Inc.
Well, the reason we want to protect is because of what's going on now, but people are living longer and longer, so we need to grow as well. And that is built into the plan. And we answer all those questions like, should you be doing Roth conversions right now when your portfolio's gotten beat up? And taking them through Medicare and Social Security and all the things that come up. Though that's so important.
Well, no one wants to suffer market losses. Unfortunately, volatility and the potential for losses are a part of the investment experience, but considering protection does not have to mean that you give up on the potential for growth and gains and forward progress. That is why having that Protect and Grow retirement blueprint is so important, ladies and gentlemen. And if you would like to get personalized strategies, custom designed for you with diversified long-term strategies implemented for your goals, pick up the phone and give Tim Stearns, CFP, and TJ Stearns Inc. a call, 800-640-2256, 800-640-2256. TJ Stearns is home of the Protect and Grow written retirement blueprint. Just give him a call and request the Protect and Grow plan, and you will be well on your way to feeling better, more confident about your plan, about your investments, your finance, and your outlook for the future, despite and regardless of the volatility that we are experiencing now, and we will certainly continue to experience along the way. Tim, we always appreciate you providing perspective here on the program, always keeping us with a level head and a good long-term perspective on those investments.
Well, Peter, thanks for having me, and we'd love to give some of the listeners out there a hand with their portfolios that have gotten beat up. Right now, we're looking good over here.
We'll give a call again for that Protect and Grow plan. Call TJ Stearns Inc. 800-640-2256. 800-640-2256. Tim, always a pleasure having you on the program.
Thanks, Peter.
Tune into Chicagoland certified financial planner Tim Stearns' full radio program and visit tjstearns.com for many valuable resources, including other great episodes of Chicagoland Retirement. Be sure to subscribe.
Investment advisory services offered through Cornerstone Securities, LLC. The information presented on this program is provided for informational purposes only without warranty of accuracy, completeness, or suitability for a particular purpose. This program is not intended to be and does not constitute financial, investment, legal, or tax advice. This information is general in nature, not specific enough to be construed as advice. You should not make any decision based on the information presented on this program without independent consultation with an appropriately licensed professional or competent advisor. Investment in securities or the market involves a potential risk for loss of principal. Trading, therefore, may not be suitable for all listeners. Annuity guarantees are based solely on the financial strength and claims-paying ability of the issuing company. Withdrawals or growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs.